Good evening. Welcome to the Earnings Review, your tidbits into company financials and operational insights. Thank you for joining us as we broadcast from our Hampton studios in Harare, Zimbabwe. I'm Ibn Mabunda, your money man. On the show, we engage top echelon executives to get you up to speed with first-hand information. We also chat with the most competent analysts on the market just to ensure you're furnished with relevant and comprehensive market analysis. Tonight, we focus on Old Mutual, a listed financial services provider on the Zimbabwe Stock Exchange. Now, this is Zimbabwe's largest financial services provider that has been in operation for over 118 years. Some quick facts: the entity provides a wide range of financial services, including banking, insurance, asset management, as well as unit trusts. The group is also heavily invested in properties. Their clientele ranges from individuals, SMEs, right up to large institutions. Let's have a look at their timeline to understand how they have evolved over the years. The entity was initially established in England as the England and Wales Old Mutual before it expanded into Netherlands, South Africa, and penultimately Zimbabwe. The entity was initially formed in 1845 by John Fairbairn, and by 1902 the entity had made its inroads into the then Rhodesia, now of course Zimbabwe. At that point, operations were established in Salisbury as well as Bulawayo. In the decades that followed, the entity continued to make significant progress, and by 1954, a banking unit was established that was to be known as CABS. In 1973, Old Mutual, the parent, acquired a significant stake in the Netco Bank, which was then rebranded as Netbank in 2005. 1999, Old Mutual demutualized, resulting in the establishment of a listing on several stock exchanges, which are the Johannesburg, Zimbabwean, Malawian, as well as the Namibian stock exchanges. In 2010, the Old Mutual Zimbabwe opened the Old Mutual Securities, which has since become a formidable player on the local securities market. In 2017, the parent exited the Asian as well as American markets to focus on their operations on the continent of Africa. In 2018, Old Mutual, the parent, disposed of its significant shareholding in Netbank from a 52% controlling stake to a mere 20%. In 2018, the group also went on in Zimbabwe to restructure its operations, merging them into 3 key units. Now, a look at how the group is organized in Zimbabwe. The group operates through 3 main units, which are investments, banking, as well as insurance. On the banking front would be their flagship, which is CABS, which is a leading mortgage services provider in the country. On the insurance front is Old Mutual Life Assurance, which offers long-term insurance, as well as Old Mutual Insurance, which plays on the short-term insurance front. And now to get on to their investments leg, this is where you have Old Mutual Properties, Old Mutual Investment Group, the 3 anchor investments, as well as Old Mutual Securities. Some vital stats: and as far as the group is concerned, the group has a presence in 8 African countries and a listing on 4 African securities exchanges. On the JSE, Old Mutual Limited has a market capitalization of over 54 billion rand and boasts itself as one of the largest financial services provider on the continent. On the Zimbabwe Stock Exchange, Old Mutual Zimbabwe has a current share price of 8,200 cents. The stock has moved 130% since the year started, vis-a-vis a 1,050% surge in the financials index. Comparatively, the ZSE All Share has mounted over 650% over the same period. As a caveat, the ZSE is currently under suspension. Now, on to some notable recent developments, particularly on the properties front. The group recently opened the Eastgate Market Building, adding to their portfolio of properties. And in the Ngezi area, the group has 27 hectares of land, as the group intends to explore value creation in Zimbabwe's mining industry. In the Victoria Falls area, the group also has 12.5 hectares of land in a move that is expected to create value for the group in as far as the tourism sector is concerned. This concludes the highlights news section of our show. In just a moment, we'll have a look at an earlier conversation we had with the Group Chief Executive, Sam Matsekete. Now, don't go anywhere. Good day, Sam, and thank you for joining us on the earnings review.
Thank you very much, and most welcome.
Beautiful. To get started, how are you faring with the COVID?
Yeah, no, look, I'm sure, like everybody else, we are having to make some significant adjustments in our ways of working, interactions, even our ways of, extending services to our clients. I believe that we're doing well so far in terms of those aspects, but I also think that there's still more adjustment to be made. This is a new norm now.
Fair enough. And this conversation, of course, is coming at a time of a series of transitions in as far as the group is concerned, and also you're coming through on board as the captain of the ship. How has been the experience thus far?
It has been an interesting experience, with its own challenges, like any change that one would go through. But I like the what I'm seeing. I'm enjoying working with the team. I'm enjoying the challenges that we are having to deal with, and I'm inspired by the possibilities and opportunities that we see going forward. I must say that so far, it has been excitement in terms of just getting reunited with a team that I've worked with before and a group that I've worked for before. And it has also been excitement in terms of finding myself also fitting in and getting into adding value, I would like to believe, even as we are in this challenging environment.
Fantastic. And still talking about transitions, there has been a reorganization of the group into those three units, the investment side, the banking, as well as the insurance. How has been the experience thus far? And can you give us an update in terms of how that has been progressing up to this point?
Yes, so the exercise you're referring to was motivated by just the need to reduce the levels of bureaucracy that we have in our interactions between business units. It was also intended and designed to ensure that we serve our clients in a more unified way, that we come across with our offering from across the group as Old Mutual Zimbabwe Limited, more than as individual components. Even as we will still need to have those individual business units within the group for regulatory, for efficiency reasons, in terms of how customers would be served. But the way that we have traveled so far has been to first look at how we organized in the background. That has gone very well. We have streamlined certain of our support functions. We have also merged some of the entities. The three blocks that you referred to, banking, insurance, and investments, are pretty much in place, but we obviously still have to keep insurance still separate between short-term and long-term. We considered the option to combine the license. We considered that in terms of how we would be serving the diverse target markets and segments. We felt that we would still need to probably keep those two separate in order to just ensure that the focus is preserved. So far it has gone well, and we are still now to look at the next phase that we will be getting into, and that perhaps will be felt much more by our clients. The overall and ultimate objective is to ensure that we are, as a group, positioned to offer integrated financial services and be ready, despite which area our clients touch us from, we should be ready to offer the integrated financial solutions to our clients.
Quite enlightening, Sam. Now, I want us to delve into your prior year performance, your financial performance. Can you just give us, in a nutshell, some of the highlights where your 2019 performance was concerned as a group?
Yeah, thank you very much. I think when you look at the mix of the performance, you would see us registering growth in terms of lines like fees and commissions, which are relating to service. You would probably see us also showing some strong investment returns in terms of our investment assets. The properties within that, you would see a picture that we believe is a conservative valuation approach, but one which we also believe is sustaining the ways that we see the property performance evolve over the short into the medium term. You would also see a thrust, if I was just to look at the business areas, you would probably see a thrust there from the bank leveraging transactional platforms that we have developed in the recent past, and those starting to pay dividends even as we speak going forward. Within the short-term insurance, you would have seen the effect of the de-dollarization and how it would have shown in the products that we were extending. Obviously, the challenge that you would find is how to preserve value for the insured assets and give customers the assurance that they still are going to be indemnified at the appropriate level, which is under policies written in the local currency. I'm glad to say that whilst you would have seen the disadvantage in terms of premium growth in the first 6 to 9 months of last year, from the fourth quarter, the sums assured, for example, the insurance levels in terms of the rates and everything had fully adapted to the local currency. And we would also redesigned our products so that the confidence that our customers are looking for in terms of the insurance levels are sustained. In the life business, you would probably see a trend there again, which is putting pressure on long-term life products, again, coming out of the changes that we have had. So in terms of sales, they would have slowed down a bit, talking to the products that we had at the time, which we also had then to review, basically to ensure that they can be responsive and more adaptable much quicker to the trends we started to see as we set into the local currency. In the other units, I think by and large, pretty much the same trend you would have expected us from the previous year getting into 2019. I think the one point that I would highlight, when you look at the inflation-adjusted results, you would see a significant monetary loss compared to the previous year. We believe that it is reflecting the way that the stock exchange primarily would have underperformed the inflation or the currency depreciation over a similar period. So in a way, you would have seen a starting point into 2019, which already factored in some currency movement, for example, on our unofficial markets, but which had not reflected in official numbers. And the year 2019 was kind of correcting to start to align the movements in both the stock exchange and the currency going forward. So there is that element. There's also the element of that I've referred to earlier, where you would see us having been, in our view, pretty conservative in the valuation of our property portfolio, as we were also trying to establish how the market, the real estate market, would be behaving. A lot of the transactions in that sector have been in hard currency, much less in local currency. The depth has been shallow, and we have therefore had to ensure that we infer our valuations primarily from hard currency, but be conservative in reading and learning from the experience of the trades that we had observed in terms of how we translate those valuations into local currency. So those factors would have contributed most significantly to the monetary loss, which I think is a significant number you would see in the inflation-adjusted numbers. Going forward, it should show at a different and hopefully a much lower level as we start to see parity between the movements in our investment returns, especially on the equity and property, and maybe in the currency and inflation movements.
Quite comprehensive, Sam. Thank you. Now, I want us to look at some of the key matrices in that prior year performance, starting with your your end premiums, which declined in inflation-adjusted terms from $1.5 billion in the prior year to 900 million Zimbabwean dollars. What informed that very narrative?
Yeah, it's similar issues, mainly around currency change. When we were writing the book in the prior years, and even as we were running off the book during 2019, the US dollar book, which would have kept value, if you like, would be coming down, and we would be replacing it with a local currency book. And that local currency book became a bit more difficult to sustain in sales as we were working through the adjustment of our product offering. You and I would agree that it becomes much more difficult to sell a life policy when customers and clients are almost making a view that there is a higher risk of potential loss of value, and given legacy issues that we would have had some 10, 12 years ago. So we needed to adapt the product and ensure that we also give the confidence to the market that we serve in life, mainly in life products, of the value proposition in that space. It's an ongoing challenge that we still have to attend to, and one which we believe as an industry, as an economy, we still have to look at to ensure that we sustain the role that we play in life products. Fair
enough. Now on to your interest income. In inflation-adjusted terms, again, it narrowed by about 40% from $880 million to 480. What colored that performance?
So again, interest income. When you look at the yields, which I would say would have adjusted, you would still see that the asset yields were still sub-inflationary. And when you inflation adjust your interest income in prior years, you're just moving it by inflation, when your actual return and yields for this year such that you are not making up for inflation. And again, it's a factor of disparity between interest rate movement and inflation. And we have seen this before. Once you get into hyperinflation territory, you will never have real interest rates. Neither would you have interest movements in terms of just the increases that would sufficiently make up for hyperinflation. Secondly, you would also see the makeup of our book getting into shorter term and getting less hard currency book, as well as getting the size of the book itself in terms of loan deployments failing to catch up with inflation. One reason that informs that is when you have a market which is so import dependent, anyone, or at least half the time, people would borrow so that they procure goods and services from outside. And for them to be able to do that, they would need foreign currency. If they are not able to access foreign currency, they would not borrow as much, and they would therefore also often reduce the tenors of their facilities and manage the interest burden that they are carrying. So that would inform that. But going forward, we believe that what will be more important in our lending activities is the extent to which we leverage the balance sheet and create equity out of the leverage, more than just tracking the levels of loans or levels of interest rates.
On a positive one, your clientele base grew there from 1.2 million to 1.3 million. What colored that very narrative?
I think it is talking to sustained sales efforts, but when you compare that to the annual premium end or levels of increase in our written premiums, you would actually see that it is also talking to the mix of the products that are being bought. So we managed to sell to more clients, but the developments in our macro environment have meant that the average sales per individual have come down. So products such as funeral, we pushed volume in that space. In our banking operations, we pushed volumes in terms of our current account or transactional accounts. In short-term insurance, we also sustained customer growth across all our offering, mainly in retail. And then similarly, you would see a trend in our microfinance as well as our investment returns, our investment offering. But the key drivers would be in our life and funeral, as well as in our banking. But we are now needing to ensure that we enhance the product itself so that the yield in sales per customer goes up, and we start to see commensurate increases in the levels of premiums and other revenue lines.
And still talking about premiums, how are you dealing with value erosion, considering the fact that this is something that is pretty much a deja vu? We saw this in 2008, and there are indicators or telltale signs that things could be headed in that very direction. How are you navigating that turbulence there?
I think this is a point that really needs to be explored and discussed in a broader sense, and I'm sure that the likes of Equity Access will assist in this one. When you are in the business of financial intermediation and you play the role to gather assets or deposits or premiums, you want to be able to invest the assets you have gathered in the market and be able to get returns that would justify and sufficiently reward the risk that's being taken, and one of the risks being to ensure that you don't get value erosion. So when you are in a market and a macro economy which is faced with the challenges such as we face, and it's broader, it's a market-wide phenomenon, it cannot be the responsibility of any single player within that market to try and still sustain certain levels, whether it's of investment, of returns, of activity, economic activity, and so forth. There are requirements we need to be focusing on as industry, as an economy, to ensure that the minimum that is required to support the activities of any financial intermediation player, anyone that's holding investments, anyone that's looking for returns, would actually be able to achieve their objectives. So part of what we have to do is beyond what Old Mutual can do on its own. It is what we have to do as an environment, as an economy, ensure that the right ingredients are in place. And we believe that authorities are also occupied with the same question, to say, how do we sustain levels of production to go up? Because it's when levels of production go up that the economy starts to create value, and anyone that's investing can start to tap into that value. If levels of production are not there, anyone and everyone will be looking for value and not finding enough value. We are wanting to ensure that we look at the ways that we manage parity of purchasing power between our local market and the markets we trade with, to optimize the balance between imports and exports, and ensure that as an economy we generate overall returns for the economy, and within which individual players can participate and attribute that return to the various investors. So I'm just seeking here to ensure that we place the discussion in the right context, and how any individual player, us included, would really cherish the support of what the macro environment would also present. That having been said, there is also the space to be played by individuals and to be played by Old Mutual. You will see us skewing our investments towards the real assets. Our investment and asset allocation will try and ensure that we hedge as much as we can against the phenomenon of hyperinflation. You would also see us getting into non-traditional investment classes. We would be looking at alternative investments where we would also seek to play a role to excite economic activity, but in the process access returns that may not be available through public investment instruments, publicly traded investment instruments. You would also see us sustaining, development projects in our property investments, and we would be participating in those for our policyholders as well as for third-party funds. And when we get into monetary investments, you would see us trying as much as possible to ensure that we get the highest yields that are available within that space. But that's in terms of what we can do in terms of asset allocation, in terms of asset selection, and then thirdly, in terms of getting into new frontiers to try and excite new economic activity. So between what we do, which should be in support of even the government policy thrust to reignite the economy, I think we should also see equal efforts by economic agents and policymakers to sustain the same thrust.
I would need us to get into a discussion where your futuristic investments are concerned. But just before we wrap up on, especially on the insurance side, there is a growing demand across the board for cover in harder currencies. How are you responding to that?
Yeah, so at the moment, in terms of the regulatory requirements in place, our offering is now defined differently from what it was prior to June 2019. We indemnify the majority of our risks and extend cover for life in local currency, and that's the requirement. If we look at short-term insurance, there are businesses indeed that require hard currency cover. We are allowed to approach regulators for exceptional accommodation to extend such cover where the business requirements and the risk itself that is being taken by that business necessitates foreign currency cover. So the avenue that's there is that we would be extending hard currency cover, but it's more in terms of exceptional approvals, in terms of regulatory requirements than the standard practice. We believe that when SI 85 came through, and you would remember that it started to allow settlement of local currency invoices, which include premiums in hard currency at the official exchange rate. What we need to also explain is that the indemnification is still in local currency. The settlement for the premiums is allowed in hard currency. We believe that once we get to the space where the exchange rates, we are expecting to align to the purchasing power parity we observe elsewhere, that may give us more room to underwrite in hard currency and also indemnify in commensurate value. So if you look at it, if somebody settles for the premiums in hard currency, the advantage that they may have is that we would not need a review of the sums insured as frequently as we would if somebody settled in local currency. But we must just say that it's limited scope at the moment.
Another factor that I may just need you to highlight on is your banking aspect of the business, particularly how that your non-funded income in inflation-adjusted terms came in at about 500 million Zimbabwean dollars. What is the strategic focus of that very unit?
We would like to ensure that we leverage digital channels more effectively. We want to be able to grow transaction volumes on those platforms. We would also like to ensure that our extent of cross-selling of products to each of the clients that we have on our books it continues to grow. Leveraging our integrated financial services that we have across our business units, we would also like to see growth which is supported by the various business units within the group. So our thrust is to still continue to grow the non-funded income. Its weight must grow, and we have got some targets that we have internally.
What savings are you hoping to derive from the digital initiatives that you have undertaken, perhaps over a 3-year horizon?
Yeah, so over a 3-year horizon, look, I think there would probably be 3 key benefits that we are looking at. So the first one is to be able to sustain the transaction volumes, the customer growth in customer numbers. We want to be able to sustain the levels of service, even surpass what we would be planning to do under the current arrangements. So that's the first one. But the second one must be in terms of efficiencies. We would like to be able to demonstrate the dividends of these digital channels in terms of efficiencies in the ways that we run our internal processes, in the way that we distribute our products, and that should show in also the way that we deploy the resources, the skills that we have into areas where maybe they won't be as much need for routine activity, but more for the skills in those people. The third one is really to be able to get the dividend of how we can integrate our offering. I think once we are on digital platforms, we are better positioned to integrate our offering from across our various areas and increase our cross-sale. Ultimately, it should show in growth in our revenues that is superior to the market. It should also show in efficiencies in our costs and therefore enhance returns. I wouldn't have specific numbers per se, but broadly those are the 3 themes that would inform our efforts on the digital channels.
Fair enough. To sort of take you back to CABS, it being quite invested where the mortgage market, and given the market vagaries that are playing out in Zimbabwe, how are you responding to that, and how are you preserving value and navigating that turbulence that has come about as a result of that?
Look, I think the main challenge in the real estate sector at the moment, if you look at the retail side of that sector, is that people want to preserve value, and they want to be able to say if they sell their properties, they are able to deploy into another asset which preserves value. There hasn't been as much depth in terms of the options available, in that space. But our role is to try and also make the market. And you would have seen CABS being involved in developments of housing, homes or housing properties. and you would have seen us, being involved at the lower end. We have also done some at the mid range. And I think we would be continuing to look for opportunities where we can run similar sort of projects into the future, to the extent that we are able to see the requirements that we need for those schemes being, satisfied under the circumstances that we have. You would also see, perhaps to the extent that we can have partnerships with some of our clients or any of the other players that are in the same sort of sector, we see opportunities to partner some of them. Some that are involved in development, some that are already having some schemes for their employees and so forth, and they require some funding which is in local currency. I think that is feasible. We participate in those schemes, but no doubt it's an area that will not be as active as it should ideally be, because you find that any player in that space is wanting to be able to transact with confidence that they don't lose value in the middle of their transactions. So once you are in hyperinflation, people tend to hold onto their assets, whether it's development land or developed land, and that will be a source of challenges for players like us. But we still continue to try.
Fair enough. And the ZSE has had quite a strong rally during the course of this year, with the market up 100% in US dollar terms, up over 600% in Zimbabwean dollar terms. How do you as Old Mutual feel about these gains?
We obviously, as investors on the equity markets, are quite, would be happy to see the market pricing itself relative to the fundamentals and the technical aspects of how the market is evolving, and therefore providing a hedge in terms of hedging against the threats of hyperinflation to an extent. We also feel that it should be taken advantage of in terms of efforts by players in capital raising initiatives. The only thing working against it is, we also need to deal with other macroeconomic conditions so that we can leverage what is happening on the stock exchange for the wider and broader good of investment players. But we are happy that at least there has been that growth, which we believe is in a way reflective of what's underpinning the businesses that are being invested in, at least so far.
But do you feel that these gains are sustainable?
Look, I think sustainability becomes the question here, because we always have to come back to the fundamentals that I referred to earlier, which are really, where is the GDP growth, where is the level of production, where are the sources of real value that we track when we look at the macroeconomy. So to the extent that those ones, continue to lag behind, and the longer they continue to do so, one could argue that then there would be a bubble that would burst at some stage. At the moment, I think there is still some chance, but we need to be looking at everything else to sustain what we are seeing on the stock market.
And how do you feel about the suspension on the fungibility and the changes that have taken place, and perhaps how that has affected potential investors into Old Mutual?
Look, I think we respect the decisions by authorities when they decide on policies such as the one that affected the Old Mutual Limited share, in barring its fungibility. I'm sure in their wisdom they also saw certain things that they would be dealing with around that. However, we also see that there would be need over the medium to the long term to give confidence to investors that we are open to them investing and divesting conveniently and with ease. And when you are investing, you look beyond the time that you are investing to the time that you will be divesting, and you start to look at, are you going to do so and realize your returns at that stage without difficulty. So that is something that we still hope will be considered going forward, not just with the Old Mutual share, but with any other investment that we seek to open to foreign investors as such. We think that in terms of how people, would have tracked the Old Mutual share price, we think that they will always be looking at the Old Mutual share price here. They will always be looking at the Old Mutual share price elsewhere, and they will always be doing maths around it. And they will always be inferring, as analysts, what they want to infer from the share price. The lack of fungibility will probably just be, for a foreign investor, a disadvantage in the meantime, but they will still be able to analyze the share and counter based on public information available wherever it is listed.
Fair enough. Now to zoom out of your operations in Zimbabwe to focus on Old Mutual, the group, we have seen some kind of turbulence in terms of the executive. How do you think that could affect your operations down here in Zimbabwe?
Well, I think here in Zimbabwe, look, like I've said, that the group has continued to sustain the momentum that it is, always aimed to have. The issues there are being resolved. They are pretty much at head office. We have never really had any direct implication or impact at the operating units in Zimbabwe. I think ours are more local issues to deal with from our environment, our economic environment, than would be, deriving from issues at our group. But it also gives us additional comfort that at least even those issues at group are now largely resolved, and we are moving forward.
Well, thank you so much, Sam. It's always a pleasure getting to engage in conversation with you, and thank you for taking the time to enlighten as well as illuminate us as well as our audience with regards to your operations there.
Thank you. We have our confidence in this market. We are celebrating 175 years as Old Mutual Group. We are celebrating 118, years here in Zimbabwe. We are here for the long haul, and we believe that our customers, all stakeholders, and the communities we serve will continue to derive value from our Old Mutual. And thank you for this opportunity.
Fantastic. Good luck with the ensuing financial season. Welcome back, viewers. That was, of course, Sam Matsekete giving us a light into the operations of Old Mutual Zimbabwe. And now joining me for conversation on their operations is our very own in-house analyst, Respect Kwenzi. Respect, good evening, and thank you for joining us on the Earnings Review.
Thank you, Eben. It's always my pleasure.
Fantastic.
Sure.
Let's get right on to it. I think there are several key issues to look at where Old Mutual is concerned, particularly given what's playing out in the Zimbabwean economy. How important is Old Mutual as a stock in the progression of things in Zimbabwe?
I think the first part should possibly focus on Old Mutual as a financial entity. I think Old Mutual is quite high up there in terms of the financial services sector contribution. They run the biggest insurance company in the country. They also run several services which include banking, asset management, and so forth. But looking at it holistically, when you look at the fund under management and also their insurance market share, it's quite huge. So they're quite phenomenal in terms of economic contribution. They are also huge in terms of the financial service sector on its own. Getting into Old Mutual as a stock, I think we are now referring to Old Mutual Limited, which is the parent company to Old Mutual Zimbabwe, which is the one that we are looking at today. So Old Mutual Limited as a stock, it has been on the stock market, listed on the stock market for over 40 years, and basically it only became a challenge a few years ago. This is around 2008, when analysts were trying to predict what the real value of our local currency could be in light of a managed exchange rate, which government was using then, and the hyperinflation, which was also concurrently ravaging the economy. So at that point, analysts had to utilize the stock or use the stock in computing an implied exchange rate, given that the same Old Mutual share, which was and is still listed on the Zimbabwe Stock Exchange, had other listings, which was then London primary listing and then JSE, among other regional bosses. So we then got to have an implied rate. But the challenge with this rate is that it always scales up beyond what might possibly be the exchange rate from the black market, and also the desired government exchange rate. This is simply because mainly investors look at buying an Old Mutual stock for preservation of value, primarily ahead of other counters. So generally on the stock market, demand for Old Mutual stock gets to be higher than other stocks, simply because you can preserve value, and secondly because it gives you a room to move money outside the country. You are able to move it between the exchanges which it is listed. So in an inflationary environment, you need an asset which preserves value. And Old Mutual as a company, as a stock that is listed on the stock market, represents the underlying businesses which are dotted across the region, and most of these regions are quite stable. So you want to lock yourself in an asset which preserves that value. So this is why Old Mutual stock has been preferred. That is in terms of demand. Now, getting to the aspect of an implied rate, you then have to say, if people are demanding so much at such a price in local currency, what is the stock's same price on the JSE? You then imply to then give you a result which you then call an implied rate. So the fundamental aspect there is to look at the reason why people get to be buying an Old Mutual stock. And the reason why people buy it is because there's an inflationary environment. There is an exchange rate system which possibly people don't believe in, or there are difficulties in foreigners moving money outside the country. So they move via that stock, among other dual-listed stocks. So this is how it has come to be so pivotal, or to be central in the discussions around currency manipulation and so forth. I think this is where Old Mutual, as Old Mutual Zimbabwe, and also as Old Mutual Limited, come into the matrix of Zimbabwe.
And clearly the authorities have felt threatened by the fungibility there, resulting in the suspension at certain periods of the fungibility there. And now we are seeing a suspension even on the ZSE. Can you shed light where that is concerned?
Yeah, so a few months back, I think 3 months to be specific, the government announced that it was suspending fungibility of shares, and they were basically targeting Old Mutual. Like I said before, the reason why people demand, part of the reason why investors on the local market demand the Old Mutual share, is because they are able to use it as an avenue of exiting the market. So we have a logjam at the RBZ, where we are finding foreign obligations difficult to settle. And now an investor, some of the investors have been on that queue for 3 years. And you have Old Mutual there as a stock, which you can buy and still dispose using the Joburg stock market. So you would rather deal with the hassle of buying on the stock market and selling in JSE, and you get your money as runs in Joburg. So now to counter that, or in fact, by implication, what that does is to increase the demand of Old Mutual price in Zimbabwe. And when this price goes up relative to a stable rand, it means the implied rate or the implied exchange rate gets to be higher in terms of the USD. So we have an exchange rate which is falling in real terms. And this is where the concern was, to say, as long as people are demanding Old Mutual shares, it simply means that the Old Mutual implied price will have to go up. So to reduce demand of Old Mutual shares, we have to stop fungibility, which is the movement part in between markets. And they had to put a 90-day vesting period, where you have to say, firstly, they put a 90-day vesting period, where you have to wait for 30, 60, 90, which is 3 months. That was the first move. So once you feel delayed, you could possibly then have to forgo that investment. So later they then had to completely suspend that fungibility, which means people are no longer buying to move their monies out. They're now buying to speculatively hold. But since this is a real asset with underlying qualities of stable currencies represented by South Africa and other regional economies which are more stable, it means that it was a bargain for the investor to move into Old Mutuals. So the demand still remains high. So I think this is the background to the dynamics around fungibility and Old Mutual implied rate as a proxy for our exchange rate. So in the latest instance, the ZSC had to gradually move in and say, no, the level of demand on the stock market is quite high. What we now need to do is to just suspend trading. Why? Because you invest your money today, 3 days later the stock market is up 20%, you've already gained 20%. You can actually go on the interbank and start demanding even more cash flows at those conservative rates. And this was creating a whole different kind of chaos to the authorities. But likewise, I don't believe that excessive controls to the market are the way to go. They kill confidence, and actually they drive away foreign direct investment and also foreign portfolio investment.
You mentioned movement in terms of the prices of the stock there, and the Old Mutual stock is up over 130%, while the financials index has surged 1,050%. How do we balance the matrix there? Of course, I want us to come back to the whole suspension of the ZSE a bit later, but can you shed light in terms of the difference or the disparity in terms of the movement of the stock there?
So it doesn't necessarily follow that if one counter moves up by a certain magnitude, then it also means that another counter in the same sector has to move by a similar magnitude. For example, if you look at 2018 and 2019, Old Mutual had superior returns compared to the average financial sector. So you have your FBC, your CBZ as counters moving at a slower rate in between 2018 and 2019. And gradually, when you are measuring 2020, which is January to May, that is up until the stock market was suspended, to June, up until the stock market was suspended, you realize that Old Mutual had a slower growth rate. But this is a culmination of, you are looking at the aspects of value to say, is my counter now at fair value? Compared to these companies which had not moved close or which had a wider variance to their market fair value. So because they were moving slow all these years, it means the gap between their fair value and their market current price was quite huge. But for Old Mutual, it was always trading close to its full value. So you would then get to see a rally in the current year which is slower than the pace of the average market. So you have FBC which stormed into the top 10, CBZ which has got gains of over 700%. Why? Is because all these years they were lagging in terms of the pace at which they were going up against the exchange rate possibly. So, and also against their fair value. So now for Old Mutual to rally as much as well when it's already close to its fair value. So that might be one of the factors. Another factor really is just to say, what base are we talking about? If your stock is growing from 1,000 to to 1,010, and another going from 1 to 2 cents. From 1 to 2 cents, it's 1 cent. From 1,000 to 1,010 cents, it's 10 cents. But when you measure the change, this one is a growth of 50. This one is a growth of less than 2%. You get it? So you can say Old Mutual in percentage terms has grown slower than FBC, which has grown from 1 to 2, which is 100%, and this one is 5%. But now in dollar terms or in the actual gains, this one might have realized low. So the aspect of best, Old Mutual trades at a price which is possibly 20 times the price of some of these stocks, and it's one of the high-priced counters in nominal terms. So the growth rate may also tend to lag that of the other peers. So those are the two key factors there.
Quite clear. But now let's move on to the suspension of trading on the Zimbabwe Stock Exchange. We have seen this before. 2008, the stock market closed for several weeks, and now we're seeing that playing out. How is this likely to affect investor confidence, and how would this affect the progression of our economy?
Yeah, this is quite fundamental. These are fundamental aspects. Looking at 2008, we had a similar hyperinflationary environment. The rates of inflation were even quite higher. But likewise, the stock market was also moving up at a very quick pace. And in November of 2018, the RBZ and the then governor Gideon Gono decided to stop trading on the ZSE up until February 19 of 2009. That is when, after the adoption of the US dollar as part of our multi-currency system. Getting now to 2020, we find ourselves in that similar hyperinflationary environment. Looking at the implication, it's quite varied. Looking at it from an investor perspective, definitely there is further distraction in terms of investor confidence. Generally, local and foreign investors will not feel safe to invest their funds on the stock market because of this kind of volatilities and uncertainties that are associated with our market. So what that means is when you have low confidence, you also expect low inflows. But this has been a gradual movement. If you look over the past 3 years, foreigners have been trying to exit this market. And if you look at the general contribution in terms of turnover, from about 60% in the early dollarization period to now less than 30%. So that really shows you that in terms of the fraction of trades, foreigners have come to really forego this market as an option. They really loved the US dollar return, and when it was abolished last year, it also dented the market's preferability. And now, getting back a few years before that, the issue of having a long queue at the RBZ where foreigners are unable to get the disposals after they sell their shares on the ZSE. These are some of the concerns that investors have always had. Add that to political uncertainty and the issue of inflation, the issue of trying out a currency before fundamentals are okay. All these have actually driven foreign investment to a record low. So presently, in fact, last week before the stock market was closed, we saw a record number of foreign investments being disposed on the ZSE. And this is really a worrying trend. Now, after the suspension, you can just imagine what levels of foreign investments could we still attract in terms of portfolios. They will still be even very low. And when you're looking at it from a foreign direct investment, with 2019 we did about 250 million from 750 the prior. So this really speaks to a depreciating or declining level of foreign investment confidence in our economy and into our investment assets.
I realize. Well, thank you so much, Respect, for the perspectives. Thank you, viewers, for staying with us. Don't forget to like, subscribe, follow us on Twitter, Facebook, and to visit our informative website, www.equityaccess.net. Remember to catch us every Tuesday, every Thursday on this very platform, 7 p.m. Central African Time. From Eben Mabunda, your money man, and the Equity Access team, Danke and ciao.